Have you ever wondered what happens when one company buys another? You hear about it in the news all the time, but what if I told you that the simple act of changing a company's ownership could set off a chain reaction of tax consequences? It can literally erase some tax benefits while creating brand new opportunities for others. Well, that is exactly what we are going to unpack today as we dive into one of the most critical and honestly fascinating areas of corporate tax, Canada's acquisition of control rules.
Now, the framework for our discussion was prepared by Dr. Samir Al-Rashani, and it really gives us a fantastic roadmap. We're not just going to look at what these complex rules are, we're going to get into the why they exist, the government's policy goals, and how they play out in very real-world practical situations.
So let's start with the big question, the one that really gets to the heart of this whole topic. Can a super profitable company, one with a big tax bill coming, just go out and buy another company that's been losing money for years and use those losses to wipe its own tax slate clean? It's a simple question, but the answer explains why these incredibly intricate regulations were ever created.
Let's paint a picture here. On one side, you've got Profit Corp. They're doing great, making a ton of money, but also staring down a massive tax bill. On the other side, you have Loss Corp. They've accumulated a mountain of tax losses over the years. Now, in a world without any special rules, Profit Corp could just swoop in, buy Loss Corp, and use that mountain of losses like a giant tax shield to shelter its own income. As you can probably guess, the government is not a big fan of this. They see it as an artificial tax dodge, often calling it loss trafficking.
Okay, so here's how we're going to tackle this. First, we'll dig a little deeper into this whole loss buying problem. Then, we'll get into the fundamental rules of what an acquisition of control, or AOC, actually is. After that, it's time for the nitty-gritty, the mechanics of asset write-downs. Then, we'll see the critical consequences of those write-downs. And finally, we'll uncover a really slick strategy known as the gains election.
All right, so to stop this kind of aggressive tax planning, the Canadian government brought in the Acquisition of Control, or AOC rules. The whole point of this legislation is to prevent companies from just freely trading tax losses like they're some kind of commodity. It's about protecting the integrity of the tax system.
So, what's the trigger? What actually sets these rules in motion? Well, it's a fundamental shift in who's in the driver's seat. Think of it as a new captain taking over the ship. The most obvious way this happens is when someone buys more than 50% of the voting shares. That's called de jure, or legal control. But the rules are smarter than that. They also look at de facto control, which is all about who has the real-world, practical power to run the show, even if they don't own the majority of shares.
Okay, the second an AOC happens, the first and most immediate consequence kicks in, a deemed year-end. Look at this timeline. The company's tax year gets slammed shut on the day right before the control change. This forces a clean break. It draws a very clear line in the sand, separating the company's old life, pre-acquisition, from its new life, post-acquisition, at least for tax purposes. All right, so we've drawn that line in the sand with the deemed year-end. Now we get to the absolute heart of the AOC rules, the mandatory write-down of the company's assets. This is where the government really steps in to reset the playing field and clamp down on the transfer of unrealized losses.
But here's where you've got to pay close attention. The rules don't treat every asset the same way. They're applied differently across 4 key categories, and understanding the unique treatment for each is absolutely essential to getting the big picture. So let's break them down.
First up, inventory. This one's pretty logical. The rule says if your inventory's fair market value has dropped below what you originally paid for it, you have to write it down. This forces the company to recognize that unrealized loss, and it gets treated as a regular business loss.
And here's a super simple example. Let's say the company has inventory that costs $60,000 to produce, but now can only be sold for $50,000. The AOC rules force the recognition of that $10,000 loss right there in that final pre-acquisition tax year. That loss then goes into a pool of what we call non-capital losses.
Next up, depreciable property. We're talking about things like buildings, equipment, company vehicles. For these, we compare the tax value, which has a fancy name, undepreciated capital cost, or UCC, to its current fair market value. And if that tax value is higher than what the asset is actually worth, you guessed it, it's got to be written down.
So, for example, if a machine has a remaining tax value, or UCC, of $50,000 on the books, but you could only sell it for $40,000 today, a $10,000 write-down is triggered. We call this a terminal loss, and just like that inventory loss, it gets added to that same pool of non-capital losses.
Okay, now this is where it gets really, really interesting. Let's talk about non-depreciable capital property, things like land or shares in another company. Here again, we compare its cost, the adjusted cost base, to its fair market value. But if there's a loss here, the character of that loss is fundamentally different, and this distinction is absolutely crucial.
So let's say a piece of land was bought for $100,000, but at the time of the AOC, it's only worth $80,000. The rules force a $20,000 loss to be recognized. But here's the kicker. This is not a business loss. It's not a terminal loss. It is a net capital loss. And as we're about to see, the fate of this specific type of loss is what the whole AOC regime is really all about.
So why have we been so careful to separate all these losses into different baskets? Well, that brings us to the single most important consequence of the AOC rules. This is the reason why the government forces this whole revaluation exercise just before the new owners walk in the door.
So here it is, the bottom line. Those non-capital losses, the ones from inventory and depreciable property, they get to survive the acquisition. The new owners can carry them forward and use them. Now, there are some pretty good strings attached. They can usually only use them against profits from that same or a similar business. But the net capital losses, like that $20,000 loss on our land, they are completely wiped out. They expire. They vanish into thin air the moment the acquisition of control is complete.
So this creates a classic use it or lose it situation. You're a tax advisor, and you see this valuable $20,000 tax asset, the ability to shelter future capital gains, and it's about to just disappear forever. The clock is ticking down to that deemed year-end. Is there anything at all you can do to save that value?
Well, you'll be happy to hear that yes, there is. The Income Tax Act actually provides a really elegant, strategic solution. It's an optional rule, an election, that is the go-to tool for any savvy tax planner who finds themselves in this exact high-stakes scenario. It allows you to be proactive.
And the solution is an election that lets the company do something that sounds a bit strange at first. You can choose to recognize a capital gain on an asset that you haven't actually sold. In that final moment before the deemed year-end, you can deem a sale of another one of your capital assets that has an unrealized gain purely for tax purposes.
The process itself is just a brilliant piece of tax strategy. First, you hunt through the company's books and you find another capital asset, maybe some shares, that are worth more than what the company paid for them. Second, you elect a deemed sale price for those shares. This triggers a capital gain on paper. You can actually calculate this so the gain is exactly enough to absorb that $20,000 expiring capital loss, making the net tax impact zero. And here is the magic part. The cost base of those shares gets bumped up to the amount you elected, creating a bigger tax shield for the future. The payoff here is a real game changer. Just look at this chart. Without making this election, if the new owners later sell those appreciated shares, they might trigger a taxable capital gain of, say, $35,000. But because you made the election, you've already used that expiring loss to increase the asset's cost base. So now when they do sell it for real, the taxable capital gain is slashed all the way down to just $15,000.
You know, it's almost like tax jujitsu. You're taking a tax asset that was about to disappear, that capital loss on the verge of extinction, and you're using its own momentum to create a permanent, durable tax benefit on a completely different asset. You're saving real tax dollars for the new owners down the road.
And that really brings us to our final thought for today. At first glance, the acquisition of control rules can seem like this huge, restrictive burden, just a minefield of compliance headaches. But as that strategic gains election shows, a really deep understanding of these rules can turn tax compliance from a simple chore into a powerful tool for creating strategic value. So the question I'll leave you with is this: are you just complying with the rules, or are you looking for the opportunities to use them to your advantage?